Picture this: an investor buys shares in a promising company, watches the price climb for a few months, then sees a sudden drop. Panic sets in. The news is filled with market uncertainty. Within days, they sell everything, locking in a loss. Fast forward 6 months, and those same shares are trading at double what they sold for. This story plays out millions of times across the world, and it reveals one of investing's most painful truths. Most investors don't lose because they pick bad investments. They lose because they quit too early. The financial markets have created more wealth than perhaps any other system in human history. Yet the average person struggles to capture even a fraction of those returns. The gap between what the market delivers and what individual investors actually earn is staggering, and it's not due to lack of information or access. It's a problem of human psychology colliding with market volatility. Understanding why investors quit prematurely is the first step toward breaking this costly pattern. The invisible enemy within: every investor enters the market with the best intentions. They've done their research, set their goals, and committed to a long-term strategy. But when real money is on the line and prices start moving, something profound happens inside the human brain. The emotional response to seeing portfolio values drop triggers reactions that evolved over thousands of years to keep humans safe from physical danger. Unfortunately, these same instincts can be devastating when applied to investing. Research into investor behavior has revealed a fundamental asymmetry in how people experience gains and losses. The psychological pain of losing money is approximately twice as intense as the pleasure of gaining the same amount. This isn't just a preference. It's a deep-seated survival mechanism that made ancestors cautious about risk. In prehistoric times, losing resources could mean starvation. In modern markets, this translates into investors feeling genuine distress when their portfolios decline, even when the long-term outlook remains strong. This loss aversion creates a powerful urge to act. When markets drop, the emotional pain becomes unbearable. Investors convince themselves they're being prudent by cutting losses, when in reality they're often selling near the bottom. The same mechanism works in reverse during bull markets. The fear of missing out drives investors to buy when prices are high, and optimism is universal. This cycle of buying high and selling low is precisely backwards, yet it's the natural human response to market movements. Compounding this challenge is the herd mentality that emerges during market stress. When financial news broadcasts images of traders in distress and headlines scream about market turmoil, it becomes nearly impossible to ignore. Investors look around and see others selling, which validates their own fears. This collective behavior creates feedback loops where selling begets more selling, driving prices down further and intensifying the panic. Breaking away from the herd requires enormous psychological strength. The modern digital age has amplified these challenges. Investors can check their portfolio values dozens of times per day from their phones. Each check provides new data points to worry about. The constant stream of financial news, expert opinions, and market analysis creates an illusion that action is required. In reality, this hyperconnectivity often leads to overtrading and poor timing. The ability to execute trades instantly, without the friction of calling a broker, removes natural cooling-off periods that once helped investors avoid impulsive decisions. The devastating mathematics of early exits. The numbers paint a sobering picture of what premature quitting costs investors. Over a recent 20-year period, the stock market delivered returns of approximately 9% annually. Yet the average equity investor captured only about 6% per year during that same time frame. That 3% gap might sound small, but compounded over 2 decades, it represents hundreds of thousands of dollars in lost wealth for a typical retirement portfolio. This performance gap isn't caused by fees or bad stock picks. It's almost entirely attributable to poor timing. Investors move money in and out of the market based on recent performance, buying after strong runs and selling after declines. This pattern is exactly backwards from the principle of buying low and selling high, yet it's remarkably consistent across millions of individual investors. The impact of missing the market's best days reveals just how costly this timing game becomes. An analysis of market returns showed that an investor who remained fully invested captured solid long-term gains. But an investor who missed just the 5 best trading days during a 20-year period saw their returns cut by more than half. The cruel irony is that these best days often occur during periods of high volatility, precisely when frightened investors are most likely to be on the sidelines. The typical holding period for stocks has collapsed over recent decades. In the 1960s, investors held stocks for an average of about 8 years. By the late 2010s, that figure had plummeted to less than 8 months. This dramatic shift reflects not just the ease of electronic trading, but a fundamental change in how people approach investing. Shorter holding periods mean more opportunities to make timing mistakes and more exposure to short-term volatility rather than long-term growth. Historical data on market recoveries provides crucial perspective. Following the financial crisis that began in 2008, it took approximately 5 years for stock prices to fully recover to their previous highs. During those 5 years, countless investors sold at losses, convinced the recovery would never come. Those who remained invested not only recovered their losses, but went on to capture substantial gains in subsequent years. The 2020 pandemic crash told a different story. Markets fell sharply but recovered within months, leaving those who sold during the panic with permanent losses, while patient investors quickly saw new highs. Even the most extreme market events eventually resolve. The 1929 crash, followed by the Great Depression, stands as the worst market decline in modern history. It took 25 years for stocks to return to their pre-crash peaks. Yet even in this worst-case scenario, investors who held through the entire period eventually recovered, while those who sold locked in devastating permanent losses. Building resilience for the long game, breaking the cycle of premature exits, requires more than just willpower. It demands a fundamental shift in how investors structure their approach and manage their psychology. The first step is accepting that market declines are not anomalies to be avoided, but inevitable features of investing in equities. Over the past century, the stock market has experienced corrections of 10% or more on a regular basis. Yet over any rolling 10-year period in recent decades, returns have been positive 100% of the time. Creating a financial plan that accounts for volatility is essential. This means holding enough cash and stable investments to cover near-term needs, so temporary market declines don't force sales at unfavorable prices. Investors who need to sell stocks to pay bills during a downturn are in a fundamentally different position than those with adequate emergency reserves. The psychological freedom that comes from knowing you won't need to access invested money for years cannot be overstated. Diversification serves as both a financial and psychological buffer. Portfolios spread across different asset classes, geographies, and sectors reduce the impact of any single investment's decline. This doesn't eliminate losses during market downturns, but it can make them more bearable and reduce the temptation to abandon the entire strategy. The investor who owns a single stock that drops 30% faces enormous psychological pressure. The investor whose diversified portfolio drops 15% during the same period has an easier time maintaining composure. Perhaps most importantly, investors need to develop a clear understanding of what they own and why. Vague goals like making money provide no anchor during turbulent times. But investors who understand the businesses they own, the historical performance of their asset allocation, and the specific financial goals their portfolio is designed to achieve have a framework for decision, making that transcends daily price movements. The data overwhelmingly shows that time in the market beats timing the market. Investors who accept volatility as the price of admission to long-term growth, who build portfolios they can maintain during downturns, and who focus on years rather than months give themselves the best chance of capturing the wealth-building power of compounding returns. The investors who quit too early will always wonder what might have been. The investors who stay the course, armed with perspective and a solid plan, position themselves to actually achieve their financial goals. The choice between these two paths is made not once, but repeatedly, in the moments when fear is highest and the temptation to quit is strongest.